Sean, we've seen a lot of activity in the interbank market and with corporations, but in this environment, is that really a trade-off between hedging and not hedging for a corporate treasurer?
Certainly in the UK there has been a case to mention.
Is that currency driven?
Yes, sterling has been well, it is has been widely erratic over the last few years, but given the similarity in the US and economic cycles, the currency cable in particular has been very, very tightly range bound to reflect that. And on a number of anecdotal anecdotal evidence we've seen a lot of corporates not really hedging outside of any major range, say 140 to 170 against the dollar. Against the euro, it's a different situation because the eurozone is
I guess in this kind of like market, then products with the optionality to knock in or cut, those makes you the investor very favorable in entering.
Yes,
products.
It's premium saving, so that's the first sort of key benefit. Secondly, given the tight ranges, reverse knock-ins and knockouts can allow you a much more improved risk ratio with a defined premium payout. The one thing that corporates have to naturally hedge against, or cover rather than hedge against, is they have to limit their losses and like anyone wants to do, but it's more so important for a corporate. But in the case of sterling particularly, I think there's room to relax those rules a little bit because there's not such the greater volatility.
And I guess what we've seen here internally in this market, domestically in the market in UK, we've seen like a lot of interest in sort of trying to reduce the movements, the volatility in the P&L, in the income statements for these corporates. That's why there is like an interest growing into entering vanilla and to some extent also like exotic products.